In this learning video, we will discuss 6 key ratios used to analyze and compare the performance of mutual funds. While understanding risk tolerance, investment horizon, and financial goals are essential before choosing mutual funds to invest in, there are certain financial ratios that can help investors in picking the best funds based on their profile. Mutual fund Sahi hai. I'm sure you would have heard this phrase in the Indian mutual fund landscape. But have you ever wondered kaun sa mutual fund sahi hai? As we have a plethora of choices, we should be able to pick the right fund that is suitable to our investment goals and objectives. There are 6 key ratios of investment risk and return that we can apply to the analysis of stocks, bonds, and mutual fund portfolios. These metrics are comparable across different mutual funds and can help you in choosing the right mutual fund with the best risk-adjusted returns. Number 1. Expense ratio. Expense ratio measures the costs incurred by the fund manager for the management of a mutual fund, which typically comprises of management fees, administration and operational costs, distribution fees, etc. The formula for expense ratio is total fund costs divided by the total fund assets under management. A higher expense ratio denotes that the fund is charging more from the investors and hence, the actual returns provided will be lower. Number 2. Sharpe Ratio. Sharpe Ratio describes how much excess returns the fund is able to generate for every unit of extra risk it endures. It uses standard deviation as total risk, which includes systematic and unsystematic risk. The formula for Sharpe Ratio is the difference between the portfolio returns and risk-free rate divided by the standard deviation of the portfolio. Number 3. Treynor Ratio. Treynor Ratio is a measure of excess returns earned at a given level of systematic risk or beta. It is also known as reward to volatility ratio, since beta is the sensitivity of security returns to movements of the underlying benchmark. The formula for Treynor Ratio is the difference between the portfolio returns and risk-free rate divided by the beta of the portfolio. Number 4. Jensens Alpha. Jensens Alpha is used to calculate the return on a portfolio in excess of its theoretical expected return. It is the difference between actual returns of a fund and those that could have been earned on a benchmark portfolio with the same amount of market risk. This is the formula for Jensens Alpha. Please note that the difference between market returns and risk-free rate is called market risk premium. In essence, this equation states that the expected return on the overall portfolio is equal to the risk-free rate of return plus the market risk premium, predicated on the beta of that portfolio. The idea behind Jensens' measure is that any investment that performs better than its projected or expected risk-adjusted return, calculated by CAPM, shows that the fund manager is able to extract more mileage from his investments. It is used to determine by how much can active management increase returns above those that are purely a reward for bearing market risk. Number 5. Capture Ratio. Capture ratio helps investors identify the quality of a mutual fund across the different market phases of bull and bear markets. It indicates the intrinsic strength of a mutual fund to face the market turbulence of rallies and slumps. The up-market capture ratio is calculated by dividing the fund returns by the benchmark returns during a bull run or up market. Similarly, down-market capture ratio is calculated by dividing the fund returns by the benchmark returns during a bear run or down market. Number 6. Information Ratio. Information ratio helps investors evaluate whether a mutual fund is delivering the expected returns or not, as compared to the benchmark. It is calculated by dividing the active returns by the volatility of those returns represented by a tracking error. The formula for information ratio is derived by dividing the excess rate of return of the portfolio, over and above the benchmark return by the tracking error. Tracking error is basically the standard deviation of the excess return with respect to the same benchmark rate of return. Tracking error identifies the level of consistency in which a portfolio tracks the performance of an index. A low tracking error means the portfolio is beating the index consistently over time, whereas a high tracking error means that the portfolio returns are more volatile over time and not as consistent in exceeding the benchmark. With that, we come to the end of this video. Please do let us know in the comments if this video was useful to you. And also if you are using any of these ratios in analyzing mutual funds. Also, please subscribe to our YouTube channel, and if you're enjoying the content, be sure to drop some likes and comments and share it with your connections. Thanks for watching.